So you mentioned a very interesting point on quasi capital, which is very unique from a UAE side. Every company has that kind of a structure because capital we see 100,000, 300,000 generally. The non-current, or you can say the reserves and surplus and current account, so-called, which was used, showing millions of dirhams as a balance.
Yeah.
So first question first, how broadly we calculate the quasi capital? Point number two, I'll just add up to this. In case quasi capital is established, will that qualify for a transfer pricing interest calculation? Because I still see a lot of transfer pricing calculations being done on so-called quasi capital also. So if you can help on both the points. Anyway, we'll have a transfer pricing session also separately, but this will help others also.
Actually, once it is classified as a quasi-capital, I think we don't have to provide interest on that. Once we are classifying, it is usually what we are doing here is that if there is a current account balances, huge current account balances, we will get a special resolution passed and we will treat it as an additional share capital, or let's say quasi capital. And the terms of this is that there is no contractual obligation for the company to repay this or to pay any interest on this. So based on this special resolution passed only, we are treating this as an additional share capital. So if there is an agreement, there is no contractual obligation to pay the interest, then why should we provide interest?
I'll just maybe elaborate on a little bit on this, Neetu, just to take your permission also. So quasi capital, we have seen it is coming from multiple things. One is bank covenant document is a very important document we should refer to, where generally we have seen that bank writes wherever there are limits that you cannot withdraw the funds from the company up to this value. So that can be trigger point. I'm not saying that's equal to a quasi capital, but that can be trigger point to evaluate the quasi capital. Second, at an industry level, we should evaluate what is the debt equity ratio. So let's say if a steel industry is their example and the debt equity is 30-70, that means 30% equity I'm just referring to and 70% debt. And how your company is funding that money, if it is up to 30%, we can call that 30% as a capital plus quasi capital. That is perfectly fine. Beyond that can be interest element. But if let's say out of 10, only capital is 5% and 25% you're showing is a current account, 25%, you cannot call it a non-quasi and pay interest on that. So I think those are broad elements, and that's what I strongly believe should be looked into.